Hi everybody, today I'm going to share with you on leverage and inverse ETFs. And we call them LNI for short. However, do take note this ETF is not for everybody as the risk involved can be very much higher than the traditional ETFs that most people invest in. And I will also share with you the risk involved plus what are some of the example of the leverage ETF that is currently in the market. So the purpose of leverage ETF is to seek to deliver multiples of the performance of the index or the benchmark that they track. So the leverage ETF is able to magnify the return on the investment. And for the inverse ETF, they seek to deliver the opposite of the performance of the index or benchmark. So the objective of this ETF is to aim to deliver a return when the market is falling. However, this LNI ETF, they generate multiples on their index or benchmark is mainly on a daily basis, not over a longer term. So this is one of the key risks of the product. So they do not deliver the stated objective for a longer than 1 day. So inverse and leverage ETF is not designed for long-term investment. And when you go to invest in leverage and inverse ETF, it should actively monitor. And you see most people use it mainly for tactical trading and not for buy and hold like the normal type of ETF. So what are the key risks of this LNI product? I just take from the product information from SGX website and share with every one of you. So there are various types of risks when it comes to investment. And I just want to emphasize on what are the key risks you need to take note when you invest in this type of LNI ETFs. So the first two part is called the counterparty risk and the liquidity risk, especially when there is an issue faced by the counterparty that went bankrupt, or you may not able to sell or liquidate your ETF when there's some issue by the counterparty or due to an inefficient market. Another thing to take note is when buying LNI product, you are not meant for long-term investment, especially during a sideways market. You may lose money regardless whether you are long or short of the market. And do take note of the leverage and the inverse risk is you may lose most or all of the values over time you hold for long term. And some of the ETF use futures as a replication strategy, and that will come up with additional risk. And one of the key parts is the rolling of future contract risk and also the contango risk. So this is something that you need to take note when you're buying this type of LNI products. Do think that when you buy this type of product, there's something called daily rebalancing. Thus, this explains why even let's say you buy a 2 times ETF, let's say the market over a long-term period increased by 100%. Your ETF may not make a 200% gain. In fact, your ETF may lose money because the ETF is being rebalanced on a daily basis rather than hold until the period and they do the computation. So this is one thing to think of, especially when you due to a sideways market, this ETF will most likely underperform. And let me just show you by this example. So you can see that is Fund A, mainly just invest in the simple index, for example, like S&P 500, ETF, SPY, VOO, or you can buy on the STI ETF. Then Fund B is a 2 times long ETF, that means it's double the ETF. And Fund C is inverse, okay, shorting of this market. For example, you can short the S&P 500, short the NASDAQ, short the STI. So let's say that you invest $100 into of these 3 funds, A, B, and C. And after 100 trading days, if the market were to up 3% today, down 3% tomorrow, up 3% today, down 3%, that means the market is just up, down, up, down, up, down on a daily basis. After 100 days, if you just buy the normal index ETF, you will make a loss about 4.4% because when market go up 3% and down 3% and up 3%, you'll make a loss. But for the leverage ETF and the inverse ETF, you can see that both have lost 16.5%. Regardless whether you long the market or you short the market, you will still suffer 16.5% losses as the market only down 4.4%. So this is what I mean by Buying this ETF is not for you to buy and hold, and you'll become worse if it is a sideways market over a longer term period. Some of you may say that 3% up down daily, it may not be practical as market don't move 3% per day. Let's zoom it down to, let's say market only up 1%, down 1%. That means market is not really moving. It up 1% today, down 1% tomorrow, then up 1%. So over 100 days, let's look at this. So by doing this, the normal index actually is only almost flat. It's about 0.5% losses. But both the long and short ETF were lost about 1.98%. So you can see that your losses are actually magnified by 4 times, regardless whether you long the market or you short the market. So this is one thing to take note of when you want to buy a leverage and invest ETF, and you have to invest in the market trend. Sideways market, you may face losses regardless of whether you long or short the market. Let's look at the chart so that you may have a better picture. Let's look at S&P 500. This is just one of the trading days in the month of February, where you can see that S&P 500 for that day had go up by 2%. And you buy a S&P 3-time bull ETF, that means leverage 3 times, you make about 5.87%. It's not really directly 3, it's not really 6%, even during one day. If you do an inverse ETF, that means you go and short S&P 500 and you buy the SPXS, S means short, okay? And you can see it's down about minus 5.9%. So this is how the leverage ETF work on a day basis. But let's say you go and hold it for a longer period. You go and hold this index for 1 month. Let's look at this S&P 500. This is based on actually up to 25th of February data. So you can see that for the past 1 month, the S&P 500 actually up about 2%. And actually it went up, then there's a Ukraine war, then it come down, then it started to come back again with 2%. But you look at the long S&P 500, SPXL, it only up 4.65%. It's supposed to be a 3-time leverage, but it never up 6% due to the daily rebalancing effect. And by look at the one that short S&P 500, it down minus 8.3%. It's not down minus 6%. So this is the impact of rebalancing. So your gain actually get lesser, but your losses actually get bigger for this case. And let's look at even longer year to date, where the S&P down 8.36%, so that along the S&P, you down about 24%. But when you go in short S&P, you up about 25%. Let's look even longer, 1 year. You can see for the past 1 year, since last year, February to this year, February, S&P actually up about 14.5%. But the long S&P 500 up about 43.9%. It's not really 3 times. And the ETF, the short S&P 500 is down about 43%. Okay, it is more than 3 times in losses. So this is an example on S&P 500. Let's look at NASDAQ QQQ, the ETF, which year to date it dropped about 13%. So if you were to long NASDAQ 3 times using the TQQQ, you drop about 38%. But if you were to short NASDAQ, you make about 37%. However, do take note, you look at the volatility, the swing of the ETF, it is very wide compared to the swing of the index by itself. Some of you may want to focus on ETF that invest on the FANG stock, where the Facebook, Amazon, Netflix, and Google. There's this ETF called the FANG Plus Index 3 times Leverage ETN, which invests in this 4 FANG stock plus another 6 highly liquid stocks, which actually include Alibaba and Baidu, Microsoft, Nvidia, Tesla, we can see from here. So this is the ETF that you can invest in. It is 3 times. There is a 3-time leverage and 3-time inverse leverage on this FANG. And some of you may don't like non-US tech company like Alibaba and Baidu. Then there's another one called FANG and Innovations, where they invest in 15 highly liquid stocks focused on building tomorrow technology. And for this, you can see that you have Salesforce, you have Intel, you have Micron, okay, you have PayPal, you have Qualcomm, you have Block and Tesla. You have a 3-time leverage and also have a minus 3-time inverse leverage. So let's put these 4 ETF combined with the TQQQ and SQQQ and with NASDAQ. You can see that the performance varies over the past 5 days. And this is where the Russia start to invade Ukraine, that period. you can see there is a big spike in volatility. And you can see that this NASDAQ actually, the QQQ actually only is flat 0.19%. But you can see the BERZ lost 13.82%. And BERZ is 3 times short on the 15 technology stocks and is down 13%. But compared with the other two ETF that also short the market, actually they didn't really suffer losses. So this is something you need to take note of, because of it only invest in the 15 stocks and the market go up, the NASDAQ is flat, but the individual stocks swing may be big, and this resulted in BERZ suffer 13% losses compared to the NASDAQ that is actually flat. So now let's look at year to date. You will see that those ETF that short the NASDAQ actually is positive, and those ETF that long the NASDAQ actually is negative returns, and is negative by quite a significant margin. It can suffer losses of up to 52%, or it can also make a gain of 50%, but the NASDAQ is only down about 13%. Because you can see that the ETF, the volatility and the risk is pretty high. As I mentioned, it's not for everyone, and you see more for tactical move and mainly more for what you view on the direction of the market, and you see more for short-term trading rather than long-term buy and hold. For those that want to invest in Singapore market, there's also two LNI products that you can use to long and short the Singapore market, which was launched last year, December. The first one is called the Philip MSCI Singapore Daily 2-time leverage product. So this one is the 2-time leverage on the Singapore market. And they also have another one called the Philip MSCI Singapore Daily minus 1-time invest product. So this one is shorting of Singapore market without leverage. So it's 1 time, so it's without leverage. So theoretically, that means that if the Singapore market were to go down 1%, you will also make a 1% profit if you were to short the Singapore market. Do think that this benchmark is following MSCI, and we know that Singapore, there is the common ETF is called the STI ETF, which consists of only 30 stocks listed in Singapore. But there's an ETF called MSCI Singapore ETF that only have 19 stocks. I'm going to expand to 20 stocks. And of these stocks, there's one stock that's not listed in Singapore. That stock is C Limited. You can see that C Limited is the 4th biggest holding in this MSCI Singapore Index, just after the banks. But compared to the normal STI ETF, you will not see C Limited in this. And also, actually, as of end February, Grab was also being included into the MSCI Singapore Index. Currently, the MSCI Singapore Index will have Grab and also got C Limited inside. But compared to the normal STI ETF, where only have 30 stocks that's listed on Singapore SGX. But for the MSCI Singapore Index, and there's an MSCI Singapore ETF, you only have 20 stocks and they got C Limited and Grab inside. So this is the differences between these two ETFs. Let's look at the year-to-date performance at STI compared with the MSCI Singapore Index ETF and also the two LNI products that's launched in December. So from here, you can see the STI as of 25th of February, actually it is up about 1.22%. But the MSCI Singapore ETF is down about 2.9%. Why? Because there is C Limited inside, and C Limited is a big contributor to the index. And we know that C Limited has come out quite a fair bit this year. And thus, MSCI Singapore Index down about 2.9%. And what about the two LNI products? The SSS, the 1-time inverse shorting of the market, is flat about 0.1%. And the LSS is a 2-time leverage of MSCI Singapore, is negative about 4.9%. And let's look at the 5-day movement. You can see that actually the STI was down about 5.23%, but the MSCI ETF down about 3.72%. But you can see the one that's short 1-time inverse is up about 3, and the leverage is -7. And however, do think like were to want to invest in these two ETN products, do check out the liquidity of it, as it's a pretty new products and is mainly designed for sophisticated investors and designed for short-term trading and especially for day trading. This is a summary of the performance table of the LNI products compared to the index. Do think that this product is not meant for everybody and it's not meant for buy and hold for long term. And all these leverage products and inverse products are under SIP category, which is called a specific investment products. where you need to pass your CAR, then you are allowed to invest in. The minimum investment quantity is 1 share, regardless of you buying the S&P 3 times, NASDAQ leverage 3 times, or even buy the Philip MSCI Singapore daily inverse product or leverage product. The minimum investment quantity is 1 share, but you need to check on your brokerage commission when you're buying the 1 shares. That's all I have to share with you today. And if you feel that this video has benefited you, do remember to like and share this video. And also do remember to leave your comment below to let me know what you think. Lastly, do remember to subscribe and press the bell button so that you'll be notified on my next video. I shall see you in my next video. Bye-bye.